but only on that amount that got you the benefit. All right. So I had mentioned that capital gains and losses, we have to net them together. We have to combine them to determine what our taxes are going to be. Okay. So we first thing we do is we calculate each of our assets to determine whether we had a gain or a loss and whether it was short term or long term. Okay, because if we sold 4 assets, one of them was a long term. So we got asset 1, 2, 3, 4. Let's say we had a $10,000 gain long term, $3,000 loss short term, $5,000 gain short term, and a $2,000 loss long term. 4 different assets. Gains, losses, long term, short term. So we have to combine all of those together. And you have to combine them in a particular order. So first thing you do is you combine all of the short-term capital gains and short-term capital losses, and all the long-term capital gains and long-term capital losses. So we're going to put these two together first. So we've got a $3,000 loss and a $5,000 gain, so we get a net $2,000 short-term gain, right, between those two. And then we're going to combine these two, and we have a $12,000 long-term loss with those two. Okay.
I think A is because gain and loss.
Oh, you're right. I thought I looked at that as a loss. Sorry. Thank you. So we have a long-term gain. You're right. $8,000 long-term gain. Thank you for keeping me honest here. Okay. So combine all short-term capital gains and short-term losses to get a net long-term or short-term capital gain or loss. Combine all long-term capital gains or losses to obtain a net long-term gain or loss. Next, finally, you combine the net short-term gain or loss with the net long-term gain or loss. So then we're going to combine these two together, and we have, well, we've got gains, right, for both of them. So I don't like that result, but okay. So $10,000 gain. 8,000 of this is going to be taxed at long-term rates, okay? This is going to retain its character. I'm going to do a different example where we get a different result here, where we have a gain and a loss. And then 2,000 of it is going to be at ordinary tax rates, okay? Let's do a little bit different, so I didn't know how that was going to end up. Let's do a $10,000 loss instead here. So now, we have a $12,000 loss long term. Okay. Now what we do is long-term capital gain and net short-term capital loss. I'm trying to see how they did this. Yeah, so if you get a net, short-term capital gain and long-term capital gain, we're gonna stop at that point, like we got with the first example there, where there's gonna be taxed at different rates, right? So we're gonna have long-term and short-term rates. If we get a net short-term capital loss and a net long-term capital loss, so we have a gain and a loss here. That's not what we have. Also, in that situation, the netting process ends. We have in total losses for both. But you'll see we're still limited to how much we can take for losses. Taxpayers have to take care to separate any gains that are taxed at 28%. 8%. If an overall net loss results, the taxpayer can deduct. We get to net these two together. So we've got a loss and a gain. We're going to net these two for a $10,000 loss. But we can only offset $3,000 of other income. This is up to a maximum of $3,000 loss. So what happens with that other $7,000? Yes, we're going to carry that forward. So the $7,000, we're going to carry forward. And it's going to stay, it's going to retain its character. So because it was net a long-term loss, this is going to be a long-term. Okay? We're going to carry it forward. It's still going to be long-term. If these had been reversed and it was a $12,000 short-term loss and a $2,000 long-term gain, we'd still have the net, but this would be carried forward as a short-term loss. What's going to happen next year is we're going to then combine that. We're going to absorb that first. We're going to combine that with other gains and losses next year. Okay, so it's not all is lost. That $7,000 can still be used next year to offset other gains. Or if we don't have any other gains next year, we get to take $3,000 and then we'll carry forward $4,000 to the next year. We keep absorbing that, right? Now, so you can, and you can carry it forward indefinitely, forever and ever and ever. It doesn't expire. I think it used to expire. So taxpayers take care to separate those. All right, so I don't know that this is really helpful, but we'll go through it. Sure, so you could have the following outcomes: a net short-term gain and a net long-term gain. That was in our first, actually we had, our first example was a gain for both, right? In that case, the short-term gains are going to be taxed at regular tax rates, and the long-term gains are going to be taxed at the appropriate tax rate depending upon, you know, what our other income is, and if they're collectibles or if they're 1202 property, that sort of thing. Okay. If we get a net short-term gain and a net long-term loss, all right, this is what we have. The loss will offset the gain. If a net short-term gain results, the short-term gain is taxed at regular tax rates. So if, for example, if this was, let's say, what am I looking for here? Let's say this was $1,000 loss, long-term. We would combine those two. Sorry, kind of a weird looking. $2,000 short-term gain, $1,000 long-term loss. We would combine them, and we would have a $1,000 short-term gain between the two of them. So that short-term gain is going to be taxed at the regular tax rates, those higher tax rates. If you get and they said long-term loss results, the loss up to $3,000, you can take that, reduces other income, any excess will carry forward forever and ever and ever, till you die, and then it's all gone. Can't take it with you. So, net short-term loss and net long-term gain. Okay, so let's say we had, so long-term gain, let's reverse these. Let's say that this is short-term and short-term and long-term and long-term. This is short-term, 12, long-term. gain. Alright, so net short-term loss and net long-term gain. In this case, you've got to separate the long-term gains, these, into their appropriate tax brackets. Any net short-term loss would first offset the 28% group. So, let's just say we had 1,000 of this was 28%, and 1,000 was at 15%. Well, we're gonna take the first 1,000 of this is gonna offset the 28%, so now we don't have a 28% rate. And then the next 1,000 is going to offset the 15%, and then we have a $10,000 short-term loss that we carry forward. So you're always gonna offset the highest tax rate first, which is nice, gives you the benefit. You know, just like when you go to a store and you get a, what is it? Like they have a buy one, get one free, and you have 3 items and they give you the free one is the more expensive one. So same sort of concept. Net short-term loss and net long-term loss. In this case, only $3,000 again of the loss is going to be deductible. First, we're going to take the short-term loss. So in this case, let's say we had loss. Let's say we have all losses. So long-term, 8,000. Short-term, 12,000. So all together, we have 20,000 in losses. We're going to use 3,000 of the short-term. Carry forward. Whoops, what the heck is that? CWFD. Close. We're going to carry 5,000 short-term forward, and we're going to carry forward all of the 12,000 long-term. Next year, it's going to retain its character. Okay. All right. Let's take a look at. Yeah, this is probably it. Can we look at this example? Yeah. All right. So let's look at Allen Masters here. So we've got some different stocks. Stock 1 was held 9 months. Short term or long term? Short term. Right. Purchased, sold. Stock 2 was held 4 months. Short term or long term? Short term. Stock 3 held 30 months. Long term. And then we've got some collectibles as well. Remember, collectibles are taxed at a 28% tax rate. So, sale price, what we sold it for, basis. So we've got a $6,000 gain for short term. We have an $8,000 loss for short term. So the first thing we're going to do is combine those two, right? So all right, so we've got a short-term gain, 6,000. We've got a short-term loss of 8,000. And then we've got a long-term gain of 18,000. And then we've got collectibles gain of 6,000. All right. First thing we're going to do is we're going to net these two together. So we get a short-term loss, 2,000. Here. And then we're left with these long-term capital gain and the 28% capital gain. Now this loss, the first thing we're gonna do is offset is collectibles. It's at the higher tax rate, okay? So we're gonna use that to offset. So that's gonna bring that down to 4,000, so we'll have a long-term gain of 18,000 and a collectibles gain of 4,000. So that's the 6,000 minus 2,000. So that 18,000 long-term, because of their other income, is gonna be taxed at 15%. The collectibles is gonna be taxed at 28%. Okay. So similar facts, stock 3 was sold for 20,000 with a basis of 38,000. Okay, so this now is a loss. Of 18,000. What's the difference there? So now we're still going to net that short-term capital loss. We're going to net all of this. We get to net these two together because that collectibles is also long-term. Oh, sorry, minus. That long-term loss is going to help offset that. So we'll have a $12,000 long-term loss. We only get 3,000 though. We get to take 2,000 of the short term. We get to take 1,000 of the long term. And then 11,000 is going to be carried forward. It's long term. Okay. All right, so the forms that we use, I know this is a lot of information. This netting thing, and you just have to read it carefully. You just have to slow down and read it carefully when you're doing your problems, okay? Or you can look at the form because it will take you through the steps, okay? So the form, can I erase this? Or are we still, okay. So with the capital gains, everything starts out on this form 8949. And the 8949 is kind of funny. So we start with the 8949. And you could have, like in our example where we had short-term, long-term, we had 4 different examples, we would then have 4 different 8949s. Because you'll see here, there are check marks. So this 8949, this particular one is only for short-term transactions that were reported on a 1099-B. Now, what is a 1099-B? 1099-B reports gains and losses from stock transactions, okay? Sometimes you get one, most times you get one. If you have a brokerage account, you know, most of the, like your bank account, brokerage account, those types of things, you will get a 1099-B. However, sometimes we have assets that don't get reported on a 1099-B. So just like at the end of the year, you get a W-2 that reports your wages. This is, at the end of the year, a report of your gains and losses throughout the year. And it will show you all that information, what your original purchase date was, your basis of the asset, what you sold it for, the date that you sold it for, and it'll have all of that there listed. But it has all of that information, even though it's going to come on one 1099-B, it may go on different 8949 forms, depending upon whether it's short-term or long-term, depending upon whether it actually showed up on a 1099-B or not. So we have assets. If you buy a piece of land, spend $10,000 on a piece of land, and then you sell that land, you're not gonna get a 1099B when you sell that land, right? You're only gonna get that 1099B when it's like a publicly traded type company. Sometimes you'll get one, but usually no. So we've got three choices. Reported on a 1099B that had the basis. It's also possible you can have a 1099B that doesn't show the basis. If you had assets that you transferred from one broker to another, and the new broker didn't get the original basis, they're not gonna have that information, right? So if the basis was reported and it's a short-term transaction, gain or loss, box A would be checked. If it was a short-term transaction, you got a 1099B, but there was no basis listed. Check B, box B is gonna be checked. If it was a short-term transaction and you did not get a 1099B, box C is gonna be checked. But each form is going to pertain to each one of these check boxes. Now we're not done because look, these are short-term, we've got long-term as well, right? So you could have 6 different 8949s. But everything starts on this 8949. And then it flows through to the Schedule D, which flows through to, this sort of flows through to the Schedule 1 or not. I can't remember off the top of my head. I'm gonna put a question mark here, which flows through to the 1040. These are capital gains. All right, so, and I think you have some of these forms to fill out. You'll see, so this is, what they have here is what we just went through. So stock 1, date acquired, sold or disposed, proceeds, cost or other basis, and then the gain or loss. So you can see, whoops. So all the short-term assets that were on a 1099B are listed on this one form. Next one is long-term. Remember we had a long-term transaction. Long-term transactions that were reported on a 1099B. So same 3 categories, but it's one's short-term, one's long-term. Stock 3, here's our, so I think this is the second, well, this is a gain of 18,000 for our long-term asset. And then we've got the collectibles, which was a long-term asset that was not reported on a 1099B. We're not gonna get a 1099B for that. So it's gonna have its own 8949. We've got 3 8949s. All of that information then transfers over to the Schedule D. So it starts here, next it goes to the Schedule D, and you'll see this Schedule D then nets. This is where we're netting everything. So all of the short-term transactions, you can see everything from those 8949s with box A checked, with box B checked, with box C checked, the totals are then carried over to this form. Okay, so each of those, so this is, again, this is where we're netting it. You don't have to worry about those 2 lines. Short-term capital loss carryover. So if we had something from last year, we had a loss from last year, this is where we bring it in, right? And we get the tax advantage then. If we had other gains, right, to offset it. Even if we didn't have other gains, we put it on there because we get to carry it forward to the next year. Remember, it lasts forever. So short-term capital loss carryover, and then our net short-term gain or loss goes here. So there's that 2,000. We transferred, those were the 2 transactions, short-term transactions here. Then down below are our long-term transactions. So box D, box E, box F. This was the stock. We had the $18,000 gain. These were the collectibles. Here we had box F checked, 6,000. Now those are long-term, but remember they're special because they've got a special tax rate. So these are combined, 18,000 and 6,000. Those are combined. So $24,000 gain, $2,000 loss. net $22,000 gain. However, we've got to pull out the 28% collectibles. Those are gonna go on line 18, and this is the amount from, and so there's a separate worksheet for that. Line 7 of the capital of the 28% rate gain worksheet. I don't know if they've got that here. Yes, they do. This is what this worksheet would look like. So again, this pulls in everything that, all those calculations that we just did. And then that gets carried forward over here. And that's all for Schedule D. But these things will get put in, let's see, where does it get put in? Let's see if they show the, oh, this is the second example of the 8949 that example that we went through. This is what that one would look like. No, they're not showing it flowing through to the 1040. Let me pull up a 1040 real quick so I can show you where that would then flow through to. So here, capital gain or loss then flows through to line 7. Now, if it's a loss, this isn't gonna be more than $3,000, right? Because 3,000 is our limit on that loss. So we don't go to Schedule 1. Again, so if you had long-term capital loss carryover, that would go here on line 14. Short-term capital loss carryover, that would go on line 6. This capital gain distributions, we are gonna talk about this, the capital gain distributions, so just kind of keep that in the back of your mind. We're gonna come back to that part. All right. I know I'm kind of zooming through here.